Welcome back to the deep dive. We know exactly why you shared these sources with us today. You're looking for the ultimate financial defense manual. You know, when the currency market starts getting really volatile, usually right before some big economic announcement, how do the pros avoid getting wiped out? So today we are diving deep into Forex hedging. These are the protective strategies traders use to guard against those, unexpected, unfavorable shifts in exchange rates. This isn't really about scoring massive gains, it's about survival. Our mission is pretty simple, to break down mechanics, the costs, and the true strategic value of hedging. We'll explore the two main paths, the perfect hedge and the more surgical imperfect hedge using options.
And the framework is just key. Most people look at trading as, all offense, but hedging is pure defense. It's essentially a short-term risk reduction tactic. You're intentionally adding new positions that are designed specifically to counteract potential losses in your main trade. Think of it like buying specialized insurance against a sudden market earthquake.
Okay, let's unpack this. Let's start with the basic reason why anyone would sacrifice potential profit for protection in the first place.
Well, the motivation becomes overwhelming when volatility is imminent. The fundamental definition, as we saw in the sources, is that Forex hedging involves opening these additional positions to actively reduce the risk of adverse moves. The strategy really shines when traders know a major market event is coming up, an election, a critical jobs report, a central bank meeting, and they just need some short-term shelter.
Right. And crucially, this isn't just for the day trader. The corporate world uses this constantly. Our sources were very clear that for multinational businesses, hedging is, well, it's non-negotiable.
Absolutely. Think about a huge multinational company, say they sell software all over the world or build cars in a dozen countries. They need to guarantee that their projected, $10 million in quarterly revenue from Europe doesn't suddenly become $9 million overnight.
Just because of some interest rate decision they had zero control over.
Exactly. For these big entities, hedging protects their cash flows, it preserves the reported value of your international assets, and it prevents those dreaded currency swings from just eating into their projected profits. They're protecting the integrity of their entire business model.
That really puts the necessity into sharp focus. But this protection, it always comes with a price, right?
Which brings us to the core trade-off. You're trading a massive potential downside risk for a guaranteed smaller upside.
Precisely. While hedging is crucial for preventing those catastrophic losses, it absolutely incurs additional costs. If you use options, for example, you pay a premium. If you take an offsetting position, you're paying carrying costs and margin. So by definition, if the market moves dramatically in your favor, your maximum potential profit is automatically reduced.
So essentially, you're choosing a guaranteed small loss, which might just be the cost of that premium over a shot at the maximum potential gain. That's not just a financial decision. That's a huge psychological shift away from maximizing returns toward minimizing risk. It is the ultimate expression of risk mitigation. For companies, this isn't about profitability, it's about structural stability. For speculators, while hedging can sometimes yield a profit, its main role is just guaranteeing that if you're wrong, your losses don't exceed some predefined, manageable limit. You are literally buying certainty.
Okay, now that we've established the why protecting an existing position from temporary chaos, let's get into the mechanics, starting with the most complete form of protection, the perfect hedge.
The perfect hedge is, well, it's exactly what the name implies, total market neutrality. A trader holds both a short and a long position at the same time on the exact same currency pair.
So if I'm long USD, I immediately open an equal short position on USD. The consequence of that is it's total paralysis. It completely eliminates all risk, but at the same time, it eliminates all potential profit while the hedge is active. It sounds so counterintuitive. Why wouldn't I just close the position entirely?
And that's the question you have to ask. Why pay carrying costs just to achieve market paralysis? The reason is strategic timing. Most often, the perfect hedge is used when a trader has a real conviction, a long-term view that, say, EURUSD is heading higher over the next year. They don't want to destroy that long-term position by closing it.
Right.
But they see a critical event coming up next week, maybe it's the ECB meeting, that could introduce some short-term, violent, temporary volatility. So instead of closing the main trade and risking missing that long-term move, they open the contrary trade for just 7 days. They get the short-term perfect hedge, the market event passes, and then they just remove the short position. Their main long trade can then continue undisturbed toward its original target.
That makes perfect sense. It's like a time machine. You freeze your risk profile, you step off the roller coaster for a minute, and then you unfreeze it once all the temporary noise is gone.
Exactly. But this perfect neutrality, it only works in specific regulatory environments, which brings up a really fascinating exception for any of our listeners who might be trading in the US.
Ah, the U.S. rule you mentioned. So how does that change the mechanics for traders there?
So in the United States, Forex dealers don't technically allow this simultaneous long-short hedging on the same pair. U.S. regulators require firms to net out the two positions. So if you hold a long position and you open a short one of the exact same size, that short order automatically closes out the long one. You're left with zero exposure. You're flat.
But wait, if I'm flat, I've liquidated my position. How does that achieve the same result as a perfect hedge?
Well, while the account technically shows a flat position, the practical effect is identical for risk management. Because the positions cancel out, the margin that was required to hold the long position is freed up, and your exposure to the market is zeroed out. You've achieved the same state of protection. Zero risk, zero immediate profit potential. It's just implemented differently on the brokerage's back end because of the regulations.
Okay, that's a critical detail for anyone using a U.S. regulated broker. The mechanics are different, but the outcome is the same. Now, let's move to the second and I think maybe more flexible strategy, the imperfect hedge, which uses options contracts.
The term imperfect is key, because unlike the perfect hedge, which completely locks down your trade, this strategy is more surgical. It typically eliminates only some of the risk and therefore only some of the potential profit. You're paying to protect a very specific area of vulnerability, not the whole position.
And there's a crucial caveat here for anyone listening. Our sources noted that options trading on currency pairs isn't universally offered by all Forex brokers. Plus, these specific Forex options, they're not traded on centralized exchanges like stock or index options are, so they function a little differently.
Right. And to use this, you need to understand the two main option types, puts and calls. If you're long a currency pair, meaning you expect it to rise, you buy put options to reduce your downside risk. That's your protection if things go wrong. And conversely, if you are short a currency pair, you expect it to fall, you buy call options to reduce your upside risk. That's your protection against the market suddenly soaring and creating huge losses for you.
Okay, let's focus first on mitigating downside risk using puts. This is the scenario where I'm bullish, I'm long a currency pair, but I'm worried about a sudden temporary drop because of some bad news.
This is your digital parachute. A put options contract gives the buyer, you, the trader, the right to sell a currency pair at a specified price. That's called the strike price. You can do that on or before a specific expiration date. And crucially, you pay a premium for that right, but you're under no obligation to actually use it.
Let's run the numbers slowly on this because this is where the precision really matters.
No.
Let's imagine a trader is long UIUSD at 1.2575. They think it's going higher, but a major bearish economic announcement is looming.
So they purchase a put option. The strike price is slightly below the current rate, let's say at 1.2550, and it expires just after that announcement passes. That 1.2550 level is their protection floor.
Okay, so scenario one. The announcement comes and goes, and EURUSD continues its upward trend exactly like the trader wanted.
In that case, which is a great case, the trader keeps their profitable long EURUSD position. The put option, which guaranteed them the right to sell at 1.2550, is now worthless because the market price is higher.
I see.
The only cost they incurred for that short-term hedge was the premium they paid up front. They made a profit minus the cost of insurance.
Now for the protection scenario two, the announcement is disastrous. USDT tanks dropping all the way down to, say, 1.2450, a drop of 125 tips.
Because of that put option, the trader doesn't panic. Their risk is strictly limited. The put option lets them sell the pair at 1.2550, even though the market is only offering 1.2550. So their loss is only calculated from their original purchase price, 1.2575, down to the strike price of 1.2550.
Wait, so even though the market dropped a massive 125 pips, my loss is pegged right there at just 25 pips. That's the key benefit we're paying for.
Exactly. The maximum loss is capped at that 25 pip distance. Plus, of course, the initial premium paid for the option. That put option is your guarantee that you will sell above the market price if the market plummets. It defines and limits your maximum downside loss, no matter how far the price actually drops.
That is definitive risk capping. Okay, now let's flip a coin and talk about the imperfect hedge for upside risk. This is when a trader is short a currency pair, betting on a fall, but is worried the price might suddenly spike because of some unexpectedly positive news.
Here we use call options. A call option contract gives the buyer the right, but not the obligation, to buy a currency pair at a specific strike price before expiration. Again, in exchange for that upfront premium. They protect a short position from a runaway market increase.
This is
Managing regret.
Protecting against the pain of being very, very wrong. Let's use the second example from the sources. A trader is short GBP USD at 1.4225. They expect it to go lower, but they fear a very bullish parliamentary vote might send the pair soaring.
So they mitigate this risk by buying a call option. They pick a strike price above the current rate, maybe 1.4275. That expires right after the scheduled vote. That 1.4275 is their ceiling.
Okay, scenario one, the vote happens and GBP USD stays low or drops even further, exactly as the trader wanted.
The trader holds on to their short GBP USD position and racks up profits. The call option expires worthless. The cost of the short-term hedge is just the premium paid. Again, profit achieved minus the cost of the insurance.
And scenario two, the vote is extremely bullish. GBP USD climbs rapidly to 1.4375. The market has moved 150 pips against the short trade. The trader is now deep underwater.
Not too deep. The call option limits that risk beautifully. Because they own that call, they have the right to buy the pair at 1.4275. So if they have to close their short position, they can just exercise the option. The maximum loss is capped by the distance between where they shorted 1.4225 and the strike price of the call, 1.4275.
Which is a 50 pip difference, plus the premium, of course.
Correct.
Yeah.
Even if the pair climbs 150 pips, the trader's loss is capped at 50 pips, plus the premium. The call can be exercised to buy the pair at that agreed-upon 1.4275 price to cover their original short position. It prevents them from having to buy it at the catastrophic market price of 1.4375.
So it functions identically to the put option, just inverted. It provides a ceiling on the loss for a short trade.
Exactly.
This has been a fascinating breakdown of mechanical protection and, really, financial insurance. So, reviewing the bottom line, hedging is fundamentally a risk reduction tool. Whether it's through a perfect offset or an option, it just softens the impact if your main trade moves the wrong way. It defines and limits your maximum possible loss.
And it's so important to connect this back to the broader context of risk. The sources reminded us that FX trading isn't inherently riskier than trading bonds or stocks. Losses depend entirely on the trader's knowledge and whether they get the trade direction wrong. Hedging just provides a very sophisticated layer of loss control for those known uncertainties.
Absolutely. And while we've discussed this using the jargon of, EUR USD and GBP USD, the core principle applies everywhere, taking an offsetting or counterbalancing position to manage uncertainty. That applies across all asset classes and, frankly, across strategic planning in general. It's a fundamental approach to mitigating known risk. So what does this all mean?
Since the goal of hedging is all about mitigating uncertainty, and both perfect and imperfect hedges incur a tangible cost, either foregone profit or an upfront premium, the real strategic question for you is how to quantify the uncertainty you face. We saw these detailed examples of guaranteed protection, 25 pips or 50 pips, for a known premium cost. The ultimate decision is determining if the cost of that guaranteed certainty is worth the risk of a high volatility event. And that framework, limiting a known risk for a defined cost, that can be applied anywhere you manage uncertainty, from business decisions to planning major life events.
That's a powerful way to frame the value of knowledge. Thanks for diving in with us on this deep dive.